Hey there, listeners. Welcome to Hines On Air, your weekly dose of inspiration, motivation, and real-life entrepreneurial stories. I'm Matt Hines, your host, and I'm excited to have you join me on this journey. From building a successful law firm to venturing into other industries like real estate and social media, I've experienced both the triumphs and the challenges that come with entrepreneurship. I've learned firsthand the importance of resilience, adaptability, and a relentless pursuit of excellence. On Hines On Air, we're diving deep into the world of business, law, and personal growth. Join me as I chat with incredible guests who have faced adversity, defied expectations, and achieved extraordinary success. We'll discuss their strategies, their mindset, and the lessons they've learned along the way. Whether you're an aspiring entrepreneur, a seasoned business owner, or simply someone looking for a little inspiration, Hines On Air is for you. Remember to subscribe, like, and leave a review whenever you listen to podcasts. Your support helps us reach more people and continue sharing these incredible stories. Let's get started. Hello, everybody. Matt Hines back with you with another Hines On Air. We got a very interesting show today. Andrew Parillo is with us. He is an expert financial advisor. He's going to tell us about how to make it through these difficult times, the change in presidents, how to navigate the whole financial industry. I think it's a fascinating topic.
It's my pleasure, Matt. Appreciate being here. Well, I'm in Williamsburg, Virginia. I had spent my professional career just outside of Boston, and I moved down here for better weather, although this winter hasn't been too much better. I'm independent. I have my own firm. I started the firm about a year ago. I had my own registered investment advisory firm with the SEC for 25 years, and I tried retirement in 1995. So I got bored, and I spent a couple of years doing nothing except getting bored. And then I wrote a book, and I said, hey, you know what? I like this. I want to keep doing this. So we can get into that if you want. But anyway, that's what I'm doing now. Well, all right. So here's the story. There's the backstory on the book. All right. So the book is right here. Beat the Wealth Management Hustle. I don't know if you could see that. And the foreword is by a guy whose name is Anthony Scaramucci, who's a friend of mine, who's a Wall Street guy. And so I wrote the book because I was at a party, the holiday party a few years ago, December of 22. The market was down 20% that year. Stocks and bonds were both down about 20%. And so I didn't know anybody there, and I introduced myself, and I said, well, I have, Andrew Parillo, I have 3 sons, a few grandchildren, and, I retired from the investment business a couple of years ago. What should I do with my portfolio? I didn't even know these folks. Wait, do you have an advisor? Because I don't, I'm not registered now, I don't, so. And then they asked me a whole bunch of questions after that, and I tried to deflect as best I could just to kind of go back to their advisors. Since these folks had some money, it was a Rotary Club party, so these were charitable people in the community that had some money. And I said, well, I don't want to get in the way of their advisor, so just probably should ask your advisor what's going on, and what's the Fed going to do next week? And I said, well, for perspective on that, the Fed started raising interest rates in March of that year, 2022. And they said they would do that until inflation started to go down. And that's what they've been doing ever since. And here we are, a few years later, they're still doing the same thing. Although they did start to make some changes to policy, but still, inflation is a problem. And so that's my perspective on it, but you should ask your advisor. I don't think it probably doesn't mean people should be making big changes to their portfolios. Now, we all know that since that time, in 2023 and 2024, the stock market's up close to 50% in those 2 years, having been down 20% in 2022. And so I said, look, I don't give predictions on what the stock market is going to do, but I just said, I say this for perspective. So anyway, and my book. So why did I write the book? I started asking friends of mine. I said, do you have an advisor? Yeah, I know they have advisors. So these folks had, some money. And do you know how much you pay your advisor? Yeah, I have no idea. I said, wow, really? No idea? Well, you probably should ask them. It's a lot of money. And I mean, I will give some, I'm not going to give a lot of numbers. I don't do charts and graphs. Okay. But the numbers are, okay. So if you have $1 million and you're investing it for 20 years and you get 7% return, which is about the return that most people target for their retirement funds. But you're paying an advisor 1%. So you really only get 6%. So what does that 1% a year add up to over 20 years on $1 million? The answer is $728,000.
Now, is that 1% on the whole principal, the million, or the 7% that's gained?
No. See, what you're doing is you're giving up that 1% return on the entire portfolio for 20 years. Because you're paying it out. You're paying that 1% out every year. So you're giving that up. And you only get 6% net return. And so the difference between the 6% net return and the 7 is $728,000. And most people are like, no way. No, because wait a minute, 1% of $1 million is only $10,000 a year. So that's only that's going to be a couple $100,000 over 20 years. But that's not the way it works because there's compound interest. And so what happens is that if they're making 7% a year, in 10 years, the account value will double. So it'll get to $2 million. Right? And then it'll go up in 20 years, it'll get to $4 million. That's 7%. And what happens along the way is if they're paying 1%, that 1% goes from $10,000 a year to $40,000 a year by the time they're done. And so the fees matter. And so the question is this. Most folks, let's face it, most folks don't want to make hard decisions about their money. And that's my view anyway. I don't know how you feel about that. How do you feel about that?
Make hard decisions? I guess my portfolios are distributed between pretty risky and then the majority of it's kind of the risk/safe.
But I'm not a day trader, so I would agree with you. I'm not studying enough every day to buy a Tesla and then sell it and then buy an Apple and I'm just not doing it. I would rather hand it to somebody and say, all right,
give me that 7-10%.
Well, the thing about it is you don't have to give to anybody to do that. You can do it on your own. And here's the thing. Okay. Let's look at this. It's okay. So if I told somebody that for $100 you could hire 500 of the best corporate managements in the world to manage your money, what would you think about that? And it wouldn't cost you anything, basically. And that's what you're doing when you buy shares in the S&P 500. That's what you're doing. You're hiring 500 of the smartest corporate managements in the world to run that money, essentially to invest your capital. And people don't look at it that way, but that's what you're doing, and that's pretty powerful. So what happens over the last 100 years? Well, the S&P started in 1926, but it's gone up about 10% a year. Okay, with dividends and no taxes. So in a retirement fund, it's up about 10% a year. And so it probably will continue to do that. That's been through depressions, through wars, through changes of presidencies, through tariff policies. Goodness sakes, in the 30s, there were tariffs that were a lot higher than we have right now. And, things came around and so it does recover. Why does it do that? It does that because corporate managements adjust to the conditions that they face. They make adjustments,
right?
So if things are going in a different direction, they're going to adjust. They're going to make some changes. They're going to course correct.
Yeah, it's interesting. I would have thought with the Biden economy, the companies would have been hurt more. I mean, I know 22 was bad,
but overall, market did good on the bike. Would you agree?
It's done really well. Yeah, it's done really well. And see, the thing about it is what's going to happen? We have a new president. I mean, I had folks contact me in last October, and we're not going to do anything because we're not sure what's going to happen with the election. I said, well, I don't know anybody that could tell you what's going to happen, with the election, in either with the outcome of the election or the market. But I can tell you this: that over time, it hasn't really made any difference, and that's hard for people to accept. Because they get bombarded with chaotic news about the market, and inflation's done this and unemployment's done that. So, but they don't have to be focused on that. They just have to stay like you, just take a long-term view, be patient, and things will work out. It's not going to go up every year. It might go down a lot, it might go down, and has. I mean, in February of 2020, when COVID became, known, the stock market went down 35% in 30 days. I mean, 35%, that's a big decline. And it started coming back. Now, it recovered all of that loss by, I think it was August of 2020. So if people, got concerned and, scared and so forth and sold after the decline, then they didn't participate in the recovery. So one of the things I say is that people say, yeah, I want to reduce my risk. The stock market has gone down. I want to reduce my risk, so I'm going to sell stocks. Okay. You're reducing your risk if the market goes down further, but you're also increasing the risk that over the long term, you're probably not going to achieve your objective. Absolutely. So it's like, and that's the hardest thing in the world for people to do. And that's basically, I say in my book, the first thing I say, the first sentence is, what problems did I solve in my life, in my professional life? I solved the problem that people have of being emotionally involved with the investments. And I worked with endowment fund trustees. So these folks they were responsible for other people's money. I was responsible to them, but they were responsible, for the endowment fund. And so it was they were serious investors and they want to be conservative, but what can I say? That's what I did. So, and we did okay at it. And, and everybody remembers, not everybody, but if they've been around for a few years, you remember that, the stock market went down quite a bit in 2008, 2009, and it came right back. And when things looked horrible, in March of 2009, it started recovering and never looked back. And so, it's just, and again, I'm not going to use a lot of numbers and charts and graphs. I don't do that, but it's just, over time, you're better just being patient. And I'm basically copying what Warren Buffett has said for years.
With the S&P, he's the one that said, hey, forget all the other things. Just S&P 500 is the way to go. And
he's right. He's right.
Yeah.
He's right. And trust me, Matt, I had portfolios with these endowment funds that were very sophisticated, sophisticated portfolio, where we had all kinds of assets. We had international stocks, we had emerging market stocks, we had global bonds, we had venture capital, we had hedge funds, we had, and if you're really careful, you can make a difference by selecting the right fund, the right strategy, and, to allocate money to. But overall, like most, you could have gotten a competitive return just by staying with the S&P 500. All right. Now, I got to tell you that so people say, yeah, it's just the S&P 500. No, all of the professional investors that I've ever known, and I've known a lot of them, use the S&P 500 as their benchmark. They try to beat the S&P 500. If they can do that, they do. Now, obviously, there are some of these hedge fund folks that are really, really good. They make quite a bit more than that, but they have different strategies, and it's not accessible to everybody. But the S&P is accessible to everybody, and it has provided a competitive return for people. So you don't have to, pay somebody to do that. It's what do the wealth managers do? The wealth managers will help people design a strategy, do some planning. Here's when you want to retire. Here's how much we can, project that you might have at these points in the future. And, and then when they set a portfolio, they don't really change the portfolio a lot. There's really no need to. But what happens is where they come into play, where they add their value, because I did this myself. I've been telling you that. Where I earned my money as an advisor was keeping people invested after the market went down. That's where I earned my money. And I worked with people who were trustees who were professional investors. And I can tell you, when they get into a committee room and the market's gone down, they all get kind of, pardon the expression, but freaked out. And what are we doing with these stocks in this portfolio? So what you're doing with the stocks in the portfolio is not for what happened in the last 6 months or 8 months or the next 6 months. It's what's going to happen over a long period of time. And, and of course it did come back. So turned out that was good advice.
Yeah, no kidding. That would have been sad if they'd have all dumped it right then.
But the way that I started in this business before the investment management industry really even started. And that was in the early 70s. But what happened is when it started, they started charging fees based on the size of the assets. They charge, typically it's 1%. It could be less, it could be more, but it's about, say, 1%. And that hasn't changed. And, we all know that how many people shop at Sears or Kmart anymore? They don't, because no one exists, right? They just go to Amazon or Walmart, which did exist back then. But, people are looking for value and price and value. And so all I'm saying is that if you're paying a fee to a wealth advisor, you have to understand what you're getting for that fee, after you pay it, because for them just to tell you every year or 18 months, or just, hey, Matt, just stay invested. Don't worry about it. We're going to be okay. It looks scary now, but it'll come back. And that's basically what they say.
You think, if I was talking to an advisor, maybe ask them how much you beat the S&P 500? Because if you're not beating that, then why not pay you 1%?
How much you beating it after your fee?
After the fee, right.
It's really hard to beat it on a consistent basis. Okay. So you think about that, and they have to make, if the S&P has been up 10% a year, which over time has been, they have to make 11% a year just to match the S&P. So why just on the S&P? And the one thing you can control is your expenses, and we all control our expenses, and so that's all I'm saying. Is I'm not advocating anything that's like rocket science. It's just kind of.
That's right. Now, if you're trying to make money, then don't spend more than you have to, trying to make more money. Yeah.
That's right. I mean, look, and there are a lot of other things around it, but, you have to decide that you're going to save, and that's a hard decision for folks to make these days when things are so expensive.
So what do you see coming up in 2024? What I've heard is pretty good news, at least in the next, I'd say, in the next 6 months or so.
Well, in 2025, I think that employment remains strong.
2025, I said 2024.
And just to put that in perspective, the average unemployment rate for 50 years is 6.2%. We're around 4% right now. So that's like really low on a 50-year basis. Okay, so that's good. Inflation is a problem, and the Fed is probably not going to lower interest rates until inflation comes down a bit. We don't know what tariffs are going to do. We're told the administration that, well, they're probably going to make higher prices for a little bit, but over the course of the cycle, it'll be lower prices. Well, I hope so. But one of the things I hope is that, just take an example, like John Deere, okay, the farm equipment maker and construction equipment maker. They've been having a tough time lately, but they're going to make adjustments. And, if there are tariffs that apply to them, they'll make adjustments, and they'll come around. So what do I think on balance? I'm positive about the United States, basically. And that might sound very too general for people to accept, but don't bet against the United States, because we are resourceful. We have a stable monetary system. We have, and I think taxes may come down. We've heard that. I hope they do.
Hell, he's trying to get rid of income taxes, which seems almost impossible, but, it's impossible.
Well, I don't know. Yeah, I don't know how to. One of the things that's interesting to me is to listen to the commentators. And if you listen to, the financial news outlets, they have folks on all the time, every day. And they have these theories about what this means and what that means. And here's what this report on inflation means, or here's what the personal consumption, expenditure number is, or, all these kind of arcane, sophisticated statistics. And they try to impute some big meaning to them. And here's what it means. Well, there are a lot of things that come into play. It's not just a couple of statistics like unemployment or inflation. It's other things. So it's tax policies. It's the do people have confidence in the future? That's a big deal. Consumer confidence. That's another statistic that gets thrown around. And you might remember, but it was a couple of years ago, at least a couple of years ago, And the narrative by the commentators was, we're going to have a recession. We are going to have a recession. Well, we haven't had a recession, have we? And so, and the stock market's done pretty well. And, is it going to do well every year? No. It's going to do no. But over time, it'll do well. And the other thing we have going on is that things change. And just look at what's happened in our world. I mentioned Amazon. 30 years ago, Amazon didn't exist, or barely existed, I guess, 30 years ago. And now people can't live without it. Right? And why is that? Because it delivers a lot of value and a lot of information on it, and you can trust them. And if you have a problem, you just send it back. They give you money back. So now that's pretty good. That's emblematic of a lot of things that are happening in the world, except in the money management industry. They've held on to these legacy arrangements. And the reality is that the average investor can go to some of the big firms and get a lot of information, a lot of services, a lot of advice for no cost without investing a lot of money. And I think people should know that. And so, basically, my book is kind of like a public service announcement. Really. So why go through all of this? Why go through all of this stuff that most people, they're intimidated by the stock market. They don't understand the chaos that they hear about every day on the financial news. So why do that? The reason to do it is because inflation will kill you over time. All right?
Question about inflation. We did a recent podcast on inflation, just the mechanics behind it.
And basically, when you say inflation, you're talking about prices increasing. They're inflating. But a lot of the Democratic message, I don't know, 3 or 4 months ago was, look, inflation's going down. It's at 3% right now, or 2.8, or whatever it is. And the prices hadn't changed. So how does the inflation rate go down, but prices don't change? Which is what inflation is.
It's not, let's be clear. Inflation is the rate of increase in prices.
Right.
Okay. It's not, that we have had deflation in our history where prices go down. Now, talk about deflation, something people could relate to, I think. You remember back just before the great financial crisis in 2007, 8, 9. House prices were going crazy. People were buying houses with no credit,
I was a real estate closing attorney. I remember sitting at the table with people, closing them, and they're saying, yeah, I'm going to get this adjustable rate, and in 6 months I'm going to get my credit up and refinance. And I was like, well, I don't know if that's going to happen. I didn't say that. That's what they were being sold. Anyway.
Well, but the point is that the price of houses crashed after that because demand dried up, because financing dried up. And the thing is, subprime mortgages were a tiny percentage of all the mortgages that were out there, but they infected the entire system. Okay. And prices went down, demand went down, prices went down. And then what happened is for a decade after that or more, we didn't have any building going on in the country. Okay. So what happened around COVID, now it's almost 5 years ago now, is the price of houses started going up. And they didn't go up a little bit. They've gone up a lot. And why are they going up a lot? Because there's not much supply. And materials prices and building costs have also gone up at the same time. So it costs more to build a house. So that's something, inflation, deflation. Well, we had deflation in the housing market. Now we've had inflation in the housing market. So inflation is the rate of increase in prices. In the Great Depression, prices went down because there's no demand. There's just no demand. And I hope we don't have deflation, but, we look here and there. Yeah, sure. There are certain prices here and there that will go down, but basically we're looking at the couple of percent a year or more right now in inflation. And just think about it. In 10 years, things are going to cost, 20, 30% more.
Yeah, but if prices are going up or they're staying up, how does the inflation rate go down? It's like they're measuring the wrong thing or something. That just doesn't make sense.
Well, the rate of inflation is measuring, again, it's the demand, it's the price, the actual price level of a basket of goods, or housing or rental, it gets very complicated and complex the way the government measures it. And I think the government kind of doesn't necessarily measure it the right way all the time.
They're
smart guy, and they were arguing. I think he was arguing with Megyn Kelly on a podcast. And we all know what prices are because we could see those. But he's arguing, look, it's dropped. Inflation's dropped from 7 to 3. And it's like, no, dumbass. Like, the prices are the same. So I was just curious how
the prices are 3% higher, than they were when they were 7% higher. A lot. Went back a couple of years ago when it was high, we don't have lower prices, and the only way to get lower prices is to have more supply and less demand. That's basically it. Now, in another sense another thing to look at in terms of what do things cost. All right, this gets down the rabbit hole a little bit, but I noticed that we all know that the packaging is kind of tricky because you're getting the same brand and you think you're getting the same thing, except it's not 10 ounces anymore; it's 8 ounces. But you're paying a little more for it. That's inflation, right? And so it's tricky. But over time, technology has made vehicles are a lot more efficient than they used to be, and less expensive than they used to be. Yeah. Well, I say they're better. I'm a car nut. Okay, so the quality and the safety and the features in a car today, compared to and think about it. If you think about the car you might have bought 10 years ago, in the meantime, the value of that money has gone down. Okay, the dollar buys less than it did 10 years ago. I don't know what the numbers are. I don't have them right in front of me, but it's down. So it only buys 80 cents worth of what it did 10 years ago. Now, we had a decade after the great financial crisis where you didn't have much inflation at all. And then, of course, COVID changed that all because the supply chains got clogged and nothing happened and inflation went up. It's come down, but it hasn't come down enough. But my point about stocks is if you had invested in stocks over that whole period, you would have been way ahead of the game. Your money would have gone up more than inflation, even after taxes. And, so that's my message to people. The only way to keep your money in, here's another way to look at it. All right, when the U.S., this is ancient history, but it's not ancient history to me because I'm an old guy, right? But in 1971, the U.S. suspended gold convertibility. Up till then, there were foreign banks that could convert their dollars into gold bullion. The United States kind of ran out of gold. So Nixon at the time said, no, we're not going to convert it anymore from dollars to gold. And so what's happened since then in 50, however many years that is now, 54 years, the value of the dollar is now down about over 90% from what it was in 1971. And
That's when they got off the gold standard in 71.
Went off the gold standard in 1971.
Which president was that? I forgot.
That was Nixon. That was President Nixon.
I think it was before Nixon.
No, 1971, it was Nixon. But
Wasn't there a lot of
coercion from different organizations for him to get off the gold.
there's been a lot of conspiracy stuff around that. The Fed, the da-da-da-da.
I don't know about that, but I do know that we didn't have enough gold to convert dollars that foreign central banks had, because it was illegal from the early 30s for citizens of the country to own gold at that time. People don't remember that, but it was. And and in fact, back in the 30s, I think it was Roosevelt, said, if you had gold, we're just going to confiscate it if you don't give it back to us or sell it, And
People didn't wear jewelry or anything then?
yeah, well, not jewelry, but gold coins. And so, but anyway, the point is we didn't have enough gold, so they started printing money at a higher rate. Because what happens is the Federal Reserve can create money out of thin air. It just does. That's the way it works.
Well, Biden put down and did a test. He said, how much can they print? Let's just take a few records here. Anyway, that's aside.
The Fed can do whatever. That's why Federal Reserve policy is important. Now, I know most people don't remember that we had, huge inflation in the late 70s and into 1980. And for whatever it's worth, and I'm kind of neutral on the whole gold thing, but the price of gold in inflation adjusted terms is really only back to where it was in 1981. Yeah, it really didn't do anything. No, it's done a lot. It's gone up a lot in the last couple of years, so people are all happy about that. But over the last however many years that is, from 81 till now, it's 50 years. It hasn't really done anything. And after inflation, that is. And then so what's the hedge against inflation? Well, it's own stocks, because companies can adjust to the environment, and they don't do it because they like it. They do it because they have to do it, because they have shareholders that demand that they get a return on their investment.
That's right. Now you made me realize something in the beginning when I were talking about what the stock market does, regardless of what president is in power. The corporations are going to make money, no matter whether Biden, Trump, or whoever's in office. They're going to make money. So I guess it is somewhat independent of whoever the hell's in the White House.
Yeah, they're going to do what they have to do to make money for the shareholders. That's their job. Yeah. That's their job.
Let me hit you with one last one. I'm running out of time, but we mentioned the Fed.
And there's this rumor stirring around that Ron Paul
might audit the Fed. You have an opinion on that?
Might do what?
Audit the Fed.
I don't. It doesn't matter to me. I think the Fed has conducted its affairs, with integrity, and I don't. It doesn't bother me if somebody audits the Fed. I mean, I don't know what they're going to find. I mean, there are reports. The thing about it is, it's kind of like this thing with Musk. Yeah, there's a website you can go to that shows government spending. It shows it. It's right there. Anybody can look at it. It's U.S. gov spending or something like that. It's right there. And the Fed, the same. The Fed publishes statistics. They can audit it all they want. What are they going to find? I mean,
I don't know that we knew all that Musk was finding out. You think we knew they were spending money on all the transgender crap in all these other countries? Did you think that was published somewhere?
I have no idea of what he's looking at there, because he hasn't told anybody really. There are some dramatic stories that come out of it, but I don't know what it really means. I mean, I guess I am a student of history, and I believe that the founding fathers were pretty smart dudes, and they put a system together that so far for almost 250 years has worked pretty well, best in the world by a lot.
I would agree with that. I don't know that the boat can stay the course 200, 300 years without some course correction. And I'm thinking right now we might get that correction. I hope that. I don't know. I'm excited.
I think the thing is, people don't understand this. Back in 1800, when Adams and Jefferson were running against each other, I mean, that was an ugly, nasty political campaign. Jefferson was a Jeffersonian democracy, was one of that. Adams was a federalist. He wanted the federal government to handle everything, and Jefferson wanted the states to handle everything. And it was ugly. So we've had a lot of political discord through our history, and we've come out of it. Maybe it hasn't been pretty. Now we had a civil war, for goodness sake. I mean, I hope we don't go back to that. But it's history is it's important. I hope we could just respect each other mostly.
Yeah, well, agreed.
That's where I come from.
Yeah,
I just want to respect every other person, and I think we have a right to life, liberty, and the pursuit of happiness. And one of the most interesting things I heard is, I never really read the Declaration of Independence, but in the 4th of July, this last 4th of July, in Williamsburg, Virginia, at the old courthouse, there was a reading of the Declaration of Independence. And I listened to every word of it, and it's powerful stuff. It's unbelievable. And people should look at that. And that's meaningful to me. That's about as political as I get.
No, I would agree with you. It was a brilliantly written document, just literary genius behind it. I thought I would agree with you.
Yeah, that was Jefferson who wrote that. Jefferson wrote that. And these.
I think I read somewhere. It wasn't like he was stood up that day and said, "I am going to write this because I'm passionate about independence and all that." It was kind of like, "You want to write it? I don't know. You want to write it? I don't know. You want to write it?" And Franklin and the boys were all kind of just throwing the duty back and forth between each other. And Jefferson was finally like, "All right, I'll do it."
Basically, Adams said, "Hey, Jefferson, you're a much better writer than anybody else here, so why don't you write it?"
Yeah.
That's what happened. But I think people should. We have such a rich history and then people should just try to understand the context of what's going on here. Now my father, I'll bring this into the conversation, is 100 years old. He was 100 in October, and he was in Europe in 1943 when he was 19 years old, right? And there was a show on Apple TV back in the spring called Masters of the Air. And it was about the B-17 crews that, that basically helped liberate the free world from Nazi Germany. That's what happened. And amazing. And it turns out the central character in that show, who was a real person that was based on fact, was a college professor of mine at Boston University.
Wow.
Yeah. Interesting, small world. But people should look at that historical stuff. And the History Channel's got great stuff. That's a great series, Masters of the Air.
Speaking of the history too, one thing I just finished is Bill O'Reilly's book, Confronting the Presidents. I don't know if you're an O'Reilly fan, but he's got his history books that he wrote. And back in that era, I didn't realize this, but when Jefferson, Adams, all those guys were running against each other, the media was still the biggest nuisance, attacking all the candidates, taking political sides. It's just as it is right now, which is shocking to me. I figured it would have gotten worse through the years. That has always been that bad.
That it was actually worse then, because it's like that. Yeah, Adams and Jefferson, they hired these writers to write this stuff, about their opponents that was not true.
I guess it was Adams, and they were. The book says 9 newspapers were just relentlessly going after him, and they were like, and they just knew this was Jefferson's doing, going to the papers, getting them to print. They were already using the media. It's crazy.
Well, I guess
Trying this respectable righteousness to those early authors and all, but no, they were just as childish as we are today.
those guys are street fighters. They were tough, but what's interesting about that, if you think about that a little bit more, is what I do is like behavioral finance. People's behavior doesn't change. People are fearful and people are greedy at the extremes, right? And there's everything in between. But that's all I'm saying is over time, people act in their best interests over time. And maybe not every day, maybe not every month, maybe not every year, but over time they do. And they recognize where the value is. And that's all I'm saying. So if you want to take care of your money, you really should study history of the markets of the S&P 500. And I keep coming back to Warren Buffett, who's easy to kind of use because everybody believes the guy, right? He's been right. He's been right.
He's just straight. I don't see any agenda or any sort of twistiness about what he says. He's just giving it to you straight.
And that's all I'm trying to say. It's just really, it's behavioral. And the other thing that people don't understand is they don't understand compound interest. So, Einstein said it's the eighth wonder of the world. And I told you that number before, 728,000 on a million for 20 years, difference between 6 and 7%. That's a lot of money.
Yeah.
That is a lot of money. And, hey, fine, if you make the decision consciously to pay that out or to forfeit that much return, that's your choice, but you should make that choice with the full knowledge that's what you're doing.
And know what to expect. If the work they're sold, all right, bam. But, if they're getting you below average or below S&P, all right, ask some questions.
That's it, man. That's the message of my book, Management Hustle. Because it's just, don't think because it's Wall Street that all these guys are, all very, are very polite and all that stuff. No, they're tough. And, you gotta, if Wall Street's selling it, I'm not sure I want to be buying it.
Oh, yeah, I got you.
Andrew?
It has been a pleasure, man.
I enjoyed it. Thank you.
Yeah, me too. I appreciate all your knowledge. And tell us, what is the title of your book in case anybody wants to get that?
Beat the Wealth Management Hustle. And if people want to go to look at more about what I've said, is I have a website, and it's called Victory Road, one word, victoryroad.com. victoryroad.com. So if you do that, you'll get the website. You'll see a link to the book and other videos that I've done. And the reason it's Victory Road is Victory Road was a location in my business address for 25 years. And it was a Bethlehem Steel shipbuilding plant in the World War I, where they built 37 destroyers for the U.S. Navy in Quincy, Massachusetts.
Wow.
That was Victory Road. So victoryroad.com is my URL, my address. Anyway, thanks, man.
I encourage everybody to check it out. Thank you again, Andrew.
Oh, thank you. Appreciate it.
Yes, sir.
All follow us on YouTube, like and subscribe, and we look forward to seeing you on the next Hines On Air.
Hines On Air is for you. Remember to subscribe, like, and leave a review whenever you listen to podcasts. Your support helps us reach more people and continue sharing these incredible stories.